Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Thursday, August the 27th, 2026, and we have a packed show this morning. Nvidia just delivered what could be the earnings report of the year. The AI trade is very much back on, and we've got jobless claims out today with NFP dropping tomorrow. Let's get straight into it. Lizzie, Nvidia just reported revenue more than doubling year over year with a 70% growth forecast for FY28. How significant is this for the broader AI trade?
Morning, Robert. This is about as significant as it gets. Nvidia reported revenue of $96.2 billion, more than double year over year, with a Q3 forecast of $108 billion and that 70% growth projection for fiscal 2028. And the market is treating it as confirmation that enterprise AI spending is not slowing down. It's accelerating. The key signal here is that Nvidia didn't just beat the numbers, it raised the ceiling on what the AI infrastructure build-out looks like over the next 2 years. And that's a meaningful distinction for investors who've been waiting to see whether demand actually holds at these levels.
DA is up 7% pre-market, but we're also seeing Salesforce up 12%, Okta up 18%, CrowdStrike over 8%. Is this a rising tide lifting all AI boats, or are some of these moves more justified than others?
The moves in CrowdStrike and Okta are genuinely earnings-driven. Both companies beat estimates and raised guidance on the back of AI-driven security demand, so those rallies have real fundamental support under them. Salesforce at 12% is a blend of a solid earnings beat and the Anthropic partnership they called Claudeforce, which integrates Salesforce's CRM platform directly into Claude. That's not just a narrative move, it addresses the concern that AI agents could eventually route around CRM platforms altogether, and the market is rewarding that strategic clarity. On the broader SPY and S&P 500 technical picture, the bias is actually neutral right now. Momentum is modestly positive, but there's no strong directional signal in either direction. So today's gap-up open will be a real test of whether this earnings catalyst is enough to shift that bias towards something more decisively bullish.
Nvidia also reportedly agreed to acquire Hugging Face for $12.9 billion. What does that tell us about where Nvidia is trying to position itself beyond just chips?
It tells you Nvidia wants to own the full AI stack, not just the hardware layer. Hugging Face is essentially the GitHub of AI models, the place where developers build, share, and deploy. And by acquiring it, Nvidia embeds itself into every stage of the AI development workflow, from chips to models to deployment, which is a significant strategic move that reframes the company's long-term earnings story, well beyond GPU sales.
Not everything is green today. Wendy's is down over 12% after Trian walked away from a take-private bid, and we've got notable moves in retail too. What's the read on those names?
When the entire thesis for owning a stock becomes the possibility of a private equity buyout, and that possibility disappears, you're left with just the underlying business, and Wendy's underlying business doesn't justify the premium the market had priced in. So this sell-off is straightforward repricing, back to fundamentals. On the retail side, Abercrombie surged 37% on a $100 million tariff refund, but comparable sales were flat, and Hollister comps were actually down 3%, which raises real questions about organic demand. That's a one-time windfall, not a business inflection. Kohl's is the more telling story though, because they reported a $150 million tariff refund, beat estimates, raised full-year guidance, and still fell 6%, which tells you the market has become quite sophisticated about stripping out these one-time items and asking what the underlying consumer demand trend actually looks like. And right now, that answer isn't convincing enough.
One strategist at Jones Trading is drawing direct parallels between today's AI rally and the dot-com bubble, favouring pharma and consumer staples instead. Is that a serious warning worth heeding against this earnings backdrop?
It's worth keeping as a risk management consideration rather than an actionable call right now, because today's AI earnings are showing actual revenue, actual cash flow, and raised guidance. That's a materially different foundation than the dot-com era, where valuations were built almost entirely on user growth and future promises. That said, the S&P 500's neutral technical bias does suggest the market isn't pricing in a runaway melt-up either. So, some caution is already baked in, and it's a reasonable reminder to stay disciplined on valuations, even in a strong earnings environment, rather than chasing momentum indiscriminately.
Steve, jobless claims are out today with the forecast at 208,000 versus last week's actual of 206,000, and NFP is dropping tomorrow. What are the labour market signals telling us right now?
Today's initial jobless claims print is expected to come in at 208,000 for the week ending August 22nd, which would be a modest uptick from last week's actual reading of 206. And it's worth noting that prior reading itself came in better than the forecast of 210,000. So the labor market continues to show a degree of resilience that complicates the case for near-term rate cuts. What makes tomorrow's non-farm payrolls report particularly consequential is that the prior July reading showed only 20,000 jobs added, a notably soft print, and the consensus for tomorrow is pointing toward a rebound into the 80,000 range, which means a wide miss in either direction will move markets significantly, given how much the Fed's next move depends on whether the labor market is genuinely cooling or simply experienced a one-month blip.
Core PCE is running at 3.3% annually, and the broader PCE is at 3.7% year over year, well above the Fed's 2% target. With consumer confidence already sliding from 50.2 to 51, how does that inflation versus sentiment combination complicate the Fed's path forward?
It creates a genuine policy dilemma because the Fed is facing sticky inflation that refuses to come down to target at the same time that consumer confidence is deteriorating. The consumer confidence reading of 51 came in below the 54.5 forecast, which tells you households are already feeling the pressure of elevated prices in their day-to-day decisions. When confidence falls while inflation stays high, the Fed can't easily cut rates to support growth without risking reaccelerating inflation, so the path forward is genuinely narrow, and tomorrow's NFP number will be a critical input into how markets price the probability of any rate action before year-end.
And all eyes turn to Jackson Hole tomorrow. What are the stakes of Fed Chair Warsh's speech given where inflation and growth currently sit?
The stakes are very high because Kevin Warsh is speaking for the first time at Jackson Hole as Fed Chair, and markets are currently pricing a September rate hike at around 40% probability given where PCE sits. So any hawkish tone, particularly around the Fed's commitment to returning inflation to 2%, could meaningfully reprice those odds higher and put pressure on equities and risk assets broadly. With Q2 GDP running at just 1% annualized and inflation still well above target, Warsh faces a difficult communication challenge, and the combination of that speech and tomorrow's NFP makes Friday a genuinely high volatility setup across virtually every asset class.
Lizzie, flip it over to crypto. Bitcoin briefly broke $80,000 earlier this week. ETF inflows have run 7 straight sessions with nearly $500 million combined. But technically, Bitcoin is leaning bearish, and Solana is flashing an outright avoid signal. How do you trade this setup?
The institutional flow story is genuinely compelling. BlackRock's IBIT alone pulled in $284 million in a single session, and Bitcoin ETF net assets are approaching the $100 billion milestone. But technically, this is not a place to be chasing new long positions. Bitcoin around $79,670 is showing a momentum indicator that puts it in extremely overbought territory, which is historically where rallies stall or reverse. And the overall bias is leaning bearish despite the strong fundamental narrative. Solana at $104 is pressing right up against a key resistance level with an even more stretched reading, making it a clear avoid technically. The signal there is about as cautionary as it gets. Ethereum tells a similar story, up 27% over 7 days and attracting $1.2 billion in ETF inflows in August alone, with analysts targeting $2,800 as the next medium-term level. But its momentum is also deep in overbought territory, making new long entries here high risk regardless of the bullish fundamental backdrop.
Bitcoin treasury companies have shed $80 billion in market cap from their peak, with 43 of the top 50 holders trading below their pre-pivot levels, and Strategy itself selling Bitcoin to meet obligations. Is the Sailor playbook officially broken?
The data makes a compelling case that the model is broken in its original form. The strategy depended on continuously raising debt and equity to fund Bitcoin purchases, which only works when Bitcoin is appreciating faster than your cost of capital, and with Bitcoin down roughly 30% over the past 12 months. That math has stopped working for the vast majority of these companies. When strategy itself is selling Bitcoin to service its obligations, that's the clearest signal that the lever has reversed direction, and the top 50 holders turning net sellers in July, offloading around 2,500 Bitcoin in aggregate, tells you the unwind is already underway rather than hypothetical, which is an important structural shift for anyone still carrying these names.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research. And don't forget to subscribe so you never miss a morning. See you tomorrow.